Friday sees the latest US jobs report coming in a week that's already seen huge volatility. We're left scratching our heads to understand exactly whether markets really care or not, quite frankly. And the key thing here is whether we are already seeing an overheating economy. Are we seeing signs of inflation with high wage growth? Or are we seeing signs of weakness that could potentially force the hand of the Federal Reserve? All of this and more, we're going to break it down for today's video into Friday's US jobs report. So first and foremost, here is the breakdown according to Trading Economics for what to expect. A normalization to a degree for the payrolls figure, 256 last time around, that's a 205, still very healthy. Certainly anything above that 200K mark is pretty nice. Unemployment rate expected to remain flat. Average hourly earnings expected flat on both the monthly and the year-on-year metric. Participation rate expected to be flat. And yeah, by and large, there's not necessarily a huge amount in terms of what markets are expecting in terms of what might cause volatility. Here's a sort of wider overview of the direction of travel for some of these key components. Unemployment rate remains relatively low. That's not necessarily something that we can say for the likes of Canada, for example, whereas we've seen that moving towards the upside. Average hourly earnings normalizing, non-farm payrolls back to the kind of area that we were pre-pandemic, and you know, we have got a wider downtrend, but as long as we sort of remain around this area, then things are healthy. And participation rate largely flatlining. What have we seen from recent surveys? So this is the Conference Board survey, and if you look into it, you can see which proportion of respondents say that they're finding it easy to find a job, so jobs are plentiful, or they're finding it hard to find jobs. And we actually have seen an uptick in terms of those finding it hard recently, and a move lower in terms of those finding it plentiful. Does that signal some sort of weakness within the US jobs market? Well, another thing to look out for is also the ISM PMI numbers, because the ISM numbers give you a breakdown in terms of inflation, so the prices paid metrics, also employment. And so for manufacturing, which is what we've already seen on Monday, we did see the figure for the employment number, which is the orange line, moving back into that 50 threshold. Now it's moving out of contraction, but it's not necessarily pointing towards overheating or anything like that, because we've essentially just got back onto an even keel. So largely the flat, sort of a neutral outlook for manufacturing in terms of jobs. In terms of the services sector, this is where you could say if you're going to see some overheating, it would come from the services sector. Out of these four lines, the troublesome one is prices paid. So essentially inflation within the services sector rearing its head according to the latest services PMI from ISM. We've got another metric coming out this week. So the latest services PMI comes out, I think it's Wednesday. Keep a very close eye on that. If we see that prices paid element spiking once again, it's a real warning sign that we could be seeing some underlying inflation pressures. But in terms of the employment side of things, it's in growth territory. It's above that 50 threshold, but it's pretty low. So it's not necessarily seeing sort of overheating, nor is it contracting. So I'd say, you know, we don't see a huge amount to worry about within these readings. When it comes to the unemployment rate, you can see on the top end, the jobless claims. So the initial jobless claims have been coming off somewhat. But you can see that continuing claims figure remaining relatively elevated. So between the two of them, we're not necessarily seeing this sort of overarching theme of sort of resurgent jobless claims or weakness in terms of the claims. And then, like I said, you know, in terms of the unemployment rate, we're pretty much just rotating around that sort of 4% mark, 4.1% mark. And that's what's expected this time around. So unless we see signs that the economy is really weakening in a meaningful manner, it looks like more of the same, really. Here's the breakdown in terms of the US jobs market. Notably, you can see in terms of that orange little section at the bottom, there have been a number of months over the course of the past year that we've seen manufacturing providing a negative impact on job creation in the US. That was the case for last month's survey. And so quite whether Donald Trump's going to be able to shift this or not, that remains to be seen. But of course, he's focused on bringing jobs to the US. That does not happen in terms of manufacturing overnight, certainly. But nonetheless, that's something we're going to be tracking. But you can see, we see a significant amount of volatility. But you've got to say, whenever we see a sort of downside move, a very low figure, it's followed up by something close to 200K. and therefore you sort of net it out, because generally you might see, strike action coming underway. You might see weather related effects. If you sort of net it out, we're around a relatively healthy area, on average, probably in the sort of mid 100s kind of area. And that's pretty decent for the US, quite frankly. Certainly, they're not necessarily in a position where the Federal Reserve needs to desperately take action as a result. In terms of wages, we can see that this is probably an area where if we did see a surge in terms of the wage numbers, that's the kind of thing that we could see some concerns emerging. And you can see that relationship between the wage numbers in terms of the average hourly earnings, which is the light blue line, that alongside that core CPI figure. So, of course, if we see a resurgence in wage growth, which is 3.9 currently, there's an expectation that will drive the likes of the core CPI and essentially inflation higher as a result. It's a key underlying factor that businesses will be pricing according to. But we haven't seen that quite yet. We're seeing it largely sort of flatlining of late. And if you're looking at the sort of month-on-month numbers, I've done 3-month annualized just so that we can sort of strip out just single month metrics a little bit, which are essentially what we've got in the red lines at the top, or the red bars. At the bottom, it's the 3-month annualized. And you can see it's been sort of drifting lower of late, getting closer to that zone that I've put here, the gray zone, which is the sort of pre-pandemic norm. So we're seeing a normalization in terms of wage growth as well. We don't necessarily have to get down to 2% per se, and we're coming back down to the kind of area that we were prior to the pandemic. Finally, we can see in terms of market expectations around the December meeting. So how many rate cuts are we going to see this year? Well, we have seen a bit of a pickup in the idea that we're not going to see any this year. And part of that probably comes down to the fears around what might happen in terms of tariffs, or how that might impact on inflation expectations. But by and large, markets are pricing between 1 and 2 rate cuts by the end of the year. So this is what we're looking to deal with. This is what we're trying to see if there's an adjustment in terms of expectations going forward. Finally, in terms of leading into the market, we're going to be talking about, first and foremost, we'll be talking about FX. So what about the US dollar? So in terms of Donald Trump, we're looking at the play-by-play moves since Donald Trump came into office last time around, or well, it was for, after the election. So last time around is orange, this time around is blue. What did we see? I mean, it's uncanny what we're seeing, quite frankly. So you see that initial pop, a pullback, another pop into the peak, then it starts to roll over, creates a bottom, retraces somewhat, and starts to sell off from there. That would point towards the rally that we've seen over the beginning of this week, potentially being the end of it, right? And then this is where the dollar weakness story really comes into play in a meaningful manner. Is that what's going to happen? Are we going to see that come to fruition? First and foremost, I'm going to actually look at the dollar index. So let's look at the dollar index. Here we go. So this is the dollar index. So we're talking about the election, which is around here. The rally, let's just clear up the screen a bit. So the rally we've seen post-election, rally, pullback, potential top, pullback. If we see this replicating what happened for Donald Trump's first stint at the White House, we then saw a retracement, and that's when it rolls over, right? And so you can see it here in terms of US elections. So let's see exactly. So that was the election there. Let's see back here. So this was the election in 2016. And so we saw rally, pullback, rally, pullback below the price swing low, retracement, and then downtrend, right? So potentially the spike that we've seen at the beginning of this week is this, right? That's the retracement. And then the bears come back into play. Possibly. Let's go back to where we are. So remember, rally, retrace, rally, and then it tops out, head and shoulders formation. So where are we now? We've got, let's get rid of these. Should clear out. There we go. So you've got from November, rally, retrace, rally, retrace. Is this a retracement before we top out? Potentially. Obviously, we haven't seen that signal, but you can look at that massive upper wick, right, on Monday. You know, that could form the basis of everyone to think, oh, phew, the whole tariff thing's not really a big issue for us to worry about. And now we can feel very confident from here onwards. Now, in terms of a pair, let's just bring up euro dollar and see this in a sort of wider context. So we can see here that we've sort of got this wider long-term downtrend. We've broken out from this sort of range here, and we've been trending lower since then. What would it take to say this is a bottom? Well, let's go back on the daily time frame. Probably a breakup through this prior high right here, because quite frankly, we've got very long-standing or pretty long-standing downtrend in play here. A break through this 105.329 gives us a double bottom formation. We haven't broken a prior swing low, so certainly if we were to break that and suddenly it looks like we've bottomed out here, this is relatively tentative signs on an early doors. We don't know what's going to happen in terms of the EU talks, China and the like. But if what's happened in Mexico happens in Canada, as what's happened in Mexico and Canada happens for the likes of the EU, the likes of China, and soon enough the whole tariff thing's sort of gone. And bear in mind, they've kicked the can down the road, right, for 1 month, but that doesn't necessarily mean that we're not going to find some sort of agreement. Donald Trump doesn't want to crash the economy, that's for sure. He wants an agreement, and that could provide the basis for a bottom here for euro dollar. So keep a close eye out on this. We're seeing tentative signs in my mind that we could be replicating pretty much play by play the move that we saw at the beginning of Donald Trump's tenure back in 2016, 2017. And then let's look in terms of the equity market. So we've seen some jitters coming in for the likes of the Nasdaq. This is so of course the Nasdaq with those big tech names, it's been an incredible performer over the years. And so we've pulled back into this on a weekly time frame. We've come back into the middle Bollinger Band, which is the 20-week SMA. And so we look for examples to show whether this has been respected or not in the past. Is this something that we should care about? So you can see back here, sort of, that was the top, that was a peak, that was a bottom. So well respected back in 22, 23. We sort of blasted through it on a number of occasions here. And now more recently, we seem to be sort of tapping it, moving away, tapping it, move away. Now, generally, if you're going to see a wide pullback, it's going to come into your sort of bottom Bollinger Band. A sort of short-term pullback comes into the midpoint and then generally sort of carries on that uptrend. So this is how we are on the daily time frame, and let's just get rid of the Bollinger Band just so that it's a little bit more clear from that perspective. So it does look like at the moment we're sort of stuck within this range almost at the moment, sort of this zone at the moment. So there's a lot of hesitancy. Of course, we're currently in the middle of earnings season. We've also got this whole Trump thing. What's this going to mean? Are we going to see a breakdown in terms of trade relations? Are we going to go risk off? All that kind of stuff. But at the moment, we're consolidating. We're set within a very bullish trend. I would say, it's probably going to take some sort of breakthrough with Trump and the likes of China to possibly pop out of this range. For the time being, it's probably quite likely we continue in this vein and start to head back towards that 21,800 for the NASDAQ. In terms of this jobs report, of course, what are the things that could derail these moves? What are the things that are going to derail the dollar weakness story or the equity strength story? Probably a resurgence in terms of inflation pressure, so wage pressures. If we see a spike in terms of wages, that could be a significant problem. If we were to see weak jobs data, be it higher unemployment rate or a weak payrolls number, for one thing, markets are probably going to think that it's just a temporary blip. For the other thing, they'll probably think of it in a positive sense of bad news is good news and probably say, well, at least that means that the Federal Reserve maybe is going to feel a little bit more confident to act. And, soon enough, Donald Trump's policies are going to come to the benefit of the economy anyway. So that's on the weak side. If we can't see particularly strong data, like really heavy jobs creation and a sharp decline in terms of unemployment, which we wouldn't necessarily expect. But if that were to happen because, the whole Trump sort of good news story has suddenly sort of invigorated the economy, then you've got the possibility of people price less rate cuts because they start thinking, he could be inflationary. The economy's doing super well anyway. But we already have markets pricing borderline 2, so essentially 1.5 rate cuts this year. And therefore, I would say they're being quite tentative as it is. If you look at the inflation outlook, I think inflation is going to come down quite meaningfully in the second part of the year. So I don't necessarily think that there's that much room for us to suddenly say, oh, we're going to get barely any rate cuts this year, because we've already got it as is. So I wouldn't be surprised to see some further upside here for equity markets, some weakness in terms of the US dollar, but a lot of it's going to come down to trade negotiations. And when it comes to the jobs report, I think probably key to it is going to be that wage number. We don't want to see higher wages, higher inflation. Those are the kind of things that could spell trouble. And that prices paid element for the ISM services PMI is going to be really key one to look out for, because that is really telling us a hell of a lot, because the inflation right now is a services-led problem. And if we see that rearing its head once again, then you start to see questions around whether the Federal Reserve is even going to be able to do anything this year. And, you know, a lot rides on that. In particular, you know, you're looking at, say, precious metals really benefits when you see interest rate cuts from the central banks. I hope this has been useful for you guys. We'll continue to provide you with plenty of content as we go through the week and through the year. Like, subscribe, and follow us for more. Thanks a lot, guys.